Welcome to the Finance by CWT YouTube channel. In this video, we're going to be looking at Robinhood stock. So first, let's look at the company's financials. They're currently trading at a PS ratio, which is price divided by sales, of 8.11, which is really high for most companies. They're also trading at a PB ratio, which is price divided by book value, of 2.22. They have a market cap of $14.85 billion. That's what the company is currently worth. And the company does have a good amount of cash. So they have $12.46 per share in cash, while the stock is currently trading at $16.86. They also are in debt. They have $3.66 billion worth of debt, which gives them a current ratio of 1.17. So current ratio is the company's ability to actually pay back their debt. Most stocks, or then like what most people are looking for with the current ratio, is a current ratio between 1.5 to 3. So with them having a current ratio of 1.17, that shows that the market is slightly worried about their ability to actually pay off that debt. So looking at the company's financials, one thing that I'll point out is that with a PS ratio of 8.11, they're trading really high against their actual revenue. And the company is not profitable. So since the company has no profit and is trading really high against their revenue, when I look at the stock, it's a stock that I need to see a lot of growth for to actually justify this. So when we look at the actual growth of this company, or the growth that they are expected, so with earnings per share in 2024 this year, they are expected to earn 21 cents per share, which would make them profitable this year, which is something that I think would be a really good thing for this stock to become as profitable. In 2025, they are expecting to see more growth. They're expecting to reach 24 cents a share, and in 2023, they actually lost 61 cents a share. So between 2023 to 2024, if they can actually get that growth and start, earning that amount of money, that'd be a good sign for the stock because it actually will be profitable at that point. And I also wanted to look at the actual company's estimated revenue. A lot of people really just look at the actual earnings per share and make sure that that is growing, which of course is most important. But when I look at a stock, I also want to see a lot of growth for the actual revenue, because if the company is growing revenue year over year, that means in turn they should be able to also grow their earnings over time year over year. So, obviously the company growing revenue is something they would need to do. In 2024, this year, they're expected to reach $2.1 billion in revenue, which would be growth of 12.7%. In 2025, they are expected to get $2.25 billion in revenue, which would represent 7.3% growth. In 2023, they actually brought in $1.86 billion. So with these, most of these are estimates. It's just the average between like the analysts, like what most of them are actually saying and predicting. So these are the actual like growth they're supposed to be experiencing. And with that, it is a good amount of growth, but the company is also trading really high above their actual revenue right now. And what I wanted to look at too is the actual chart. So this is what Robinhood has done since 2020. As you can see from the chart, the green is the actual revenue that they're doing, blue is the actual earnings. In 2021, they definitely lost a lot of money. And of course, they've lost money every year so far. But when I look at the chart, one thing I think that is alarming is that even though they are unprofitable, they really haven't been growing their revenue every year. The stock did, or at least the company did, and revenue take a hit in 2022. And, it has grown like slightly since then. But, when I look at a stock, a stock that I want to buy, I want to see them increasing their revenue every single year. And obviously, sometimes a company has a bad year, and that's fine. But with Robinhood being unprofitable, and not only just unprofitable, but losing a lot of money, the fact that they haven't been able to actually increase their revenue every year, I do think it's concerning. So my conclusion on the stock is that personally, I would not buy the stock just because I do believe that the company is trading a lot higher than their actual revenue. And when it's trading that high, I don't think they actually have the growth rate to justify the premium that we'll be buying the stock at. And because they're currently unprofitable, I do think it's a good thing that this year they're expected to become profitable. But even with that, with the current market cap of this company, I personally would not buy the stock. Some good things that they do have I feel like a good amount of cash actually on hand, but I do think the company is overvalued, and it's overvalued more. I think it's overvalued more unjustly than the actual growth rate, could really catch up. So that's my opinion on the stock, my analysis on it. If you like this video, make sure to subscribe to the channel, like the video. Thank you so much for watching.